The Vision 2030 economic blueprint identifies energy as critical to Kenya's goal of becoming a fully developed country in the next 2 decades. However, following an over-reliance on hydropower, the country is facing an acute power shortage resulting from seasons of prolonged drought, a factor which might curtail Kenya's dream of reaching the goal. And demand is high and is currently growing at 8% per annum. It is with this in mind that Kengen this week officially launched its public infrastructure corporate bond. Kenya's electricity power generator is seeking to raise 15 billion shillings through the bond offer, the largest corporate bond offering in Kenya's history, to finance its capacity expansion program.
We looked at the projects that we need to do immediately and realized that yes, we need about 15 billion shillings, up to 25 billion shillings. So what we have is 15 billion shillings as the bond, with a green shoe option of another 10 billion shillings.
It's been all action in Kenya's bond market recently, this coming off the heels of a successful infrastructure bond of about 18.5 billion shillings raised by the government in February 2009. The bond had a resounding success rate of 134%, and it is this investor sentiment that Kengen hopes to tap into.
The Treasury, the Central Bank of Kenya, and other stakeholders are spearheading reforms and indeed new initiatives in the domestic debt market. To mention but a few, we note the introduction of the benchmark bonds, the reopening of bonds, the 364-day Treasury bill, all of which have been very successful.
The bond, which will be expected to trade at the secondary market on the NSE once listed, will see the retail pool taking about 20%, while local and foreign institutional investors will subscribe to the balance of 80%.
The Kengen bond, as we have heard, has some incentives for investors. In terms of return, it is well priced, and it is also exempt from withholding tax. I therefore appeal to our retail and institutional investors to subscribe to this bond. As demonstrated in the past, the Kenyan capital market has indeed a lot of potential.
And with most of the country's power stations operating below the optimum following declining water levels in the reservoirs, Kenya's Prime Minister was quick to call for the preservation of water catchments in the country.
But why are we where we are? Two factors. One is climate change. Two, the destruction of our catchment areas. We cannot leave all that expensive equipment to go to rot.
The investment in additional generation capacity through the public infrastructure corporate bond is part of Kengen's 5-year strategy of increasing its capacity by 500 megawatts to stabilize the power situation in Kenya by 2012.
Finally, we settled on the geothermal strategy, which in absolute terms, capital, it is very expensive. That's the most expensive route. But in the long run, it is the cheapest option for this country. Even if you look at the cost per unit going forward, that's really going to be the cheapest option at about 4 shillings and 70 cents, compared with the others which would go up to about 5 shillings and 20 cents.
At the same time, the government is keen to enhance green energy as it embarks on considering other options while leveraging on the opportunity offered by capital markets as it invests in additional power generation.
We are looking at other options also. Solar is another option. Wind is another option. Biofuels is another option that's available. If we do this, we will be able to be self-sufficient in energy. Instead of thinking of importing from the Southern African power pool or from Ethiopia next door, which in my view is behind Kenya in terms of industrial development. Why do we want to install very expensive transmission lines from Ethiopia into Kenya instead of using that money to generate power ourselves within here?
Nevertheless, it is expected that this bond offer will be a turnaround that will not only offer investors good returns, but go a long way in getting rid of the energy crisis in Kenya.